October 1907. The most powerful nation on earth was hours away from total financial collapse. Banks were failing, depositors were rioting in the streets, the U.S. Treasury was empty, and the President of the United States sat helpless in the White House, watching his country descend into chaos. But one man, not a politician, not a general, not even a government official, stepped into the void. His name was J.P. Morgan. And in a single weekend, locked inside his private library on Madison Avenue, he would do what no central bank, no legislature, and no elected leader could do. He would save America. But here's the question no one asked at the time. Why did the most powerful economy in the world need to be saved by a single private citizen? And more importantly, what did he get in return? Welcome to the Wealth Timeline, where we uncover how money, power, and history are woven together to shape the world we live in. Today, we're stepping into one of the most pivotal moments in American financial history. A moment that didn't just rescue the economy, but quietly rewrote the rules of who really controlled it. To understand what happened in 1907, you have to understand what wasn't there. No Federal Reserve, no FDIC insurance, no emergency lending facilities, no safety net at all. The entire American banking system was a patchwork of private institutions, trust companies, and regional banks, all connected by a fragile web of credit and confidence. When confidence broke, the system shattered, and in 1907, it broke spectacularly. It started with a copper speculation scandal. A pair of speculators tried to corner the market on United Copper stock. The plan failed. The speculators went bankrupt, and suddenly, every bank and trust company associated with them became suspect. Panic spread like wildfire. Depositors rushed to withdraw their money. Banks that were perfectly solvent yesterday found themselves insolvent today. Not because they were broke, but because everyone believed they were broke. This is the dark magic of banking. It only works if people trust it. And in October 1907, trust was dying. But here's what makes this moment so extraordinary. The man who would save the system wasn't supposed to be its savior. He was supposed to be its villain. John Pierpont Morgan was born in 1837 into a world where banking was more art than science. His father, Junius Spencer Morgan, ran a powerful merchant bank in London. Young Pierpont learned early that money wasn't just currency. It was leverage, timing, and above all, trust. By the 1870s, Morgan had built his own empire in New York. He financed railroads, he restructured failing corporations. He assembled monopolies in steel, electricity, and shipping. He didn't just lend money, he reorganized industries. When competitors fought costly wars, Morgan would step in, force a merger, and consolidate power. He called it Morganization. Critics called it monopoly. But no one could deny it worked. By 1900, J.P. Morgan controlled more capital than the U.S. Treasury. He was the lender of last resort, not by law, but by sheer financial dominance. But here's the paradox. Morgan wasn't a risk taker. He was a risk manager. He hated speculation. He hated disorder. He believed in stability, reputation, and long-term profit. So when the panic of 1907 began, it offended him on a personal level, not just because it threatened his fortune, but because it threatened the system itself. And Morgan believed in the system, because he had spent 30 years making sure he sat at the top of it. The panic began on October 16, 1907, when the Knickerbocker Trust Company collapsed. Knickerbocker was one of New York's largest trusts, financial institutions that operated like banks, but with fewer regulations and more risk. When it failed, depositors panicked. And the panic spread to other trusts, then to commercial banks, then to the entire credit system. By October 22nd, the situation was catastrophic. Treasury Secretary George Cortelyou rushed to New York with $25 million in government funds, a pittance compared to the scale of the crisis. He went straight to J.P. Morgan's office at 23 Wall Street. Morgan was 70 years old. He had survived the panics of 1873, 1884, and 1893. He knew exactly what was happening, and he knew the government couldn't stop it. So he took command. Morgan assembled the most powerful bankers in America inside his library. a fortress-like mansion filled with rare manuscripts, Renaissance art, and the accumulated wealth of centuries. He locked the doors, and he told them, "This ends tonight." He divided them into committees. One group would assess which banks were solvent and which were doomed. Another would pool emergency funds. Another would coordinate with the government. Morgan himself moved between rooms like a general directing a battle. But this wasn't charity. Every bank that received Morgan's help had to accept Morgan's terms, and those terms always included one thing: control, seats on the board, voting rights, restructuring agreements. Morgan wasn't just saving the banks, he was consolidating them. But the crisis wasn't over. Because the real danger wasn't in the banks, it was in the stock market. On Saturday, November 2nd, Morgan received devastating news. Moore & Schley, a major brokerage firm, was on the verge of collapse. And if it failed, it would trigger a wave of margin calls that would obliterate the New York Stock Exchange. The entire market would implode by Monday morning. Morgan called an emergency meeting. The president of the stock exchange told him they needed $25 million immediately, or they would have to close the exchange indefinitely. Closing the exchange was unthinkable. It would signal total system failure. It would destroy what little confidence remained. Morgan had one option. He turned to the presidents of the city's biggest banks and said, "Gentlemen, we need $25 million in 10 minutes. Not tomorrow, not Monday, now." The room fell silent. Then one by one, the bankers began pledging funds. 5 million, 3 million, 2 million. In 14 minutes, they raised 23.6 million. Morgan covered the rest himself. The stock exchange stayed open. The brokerage survived. The panic began to subside. But Morgan wasn't finished, because embedded in that rescue was a deal that would change American industry forever. Moore & Schley's biggest asset was a controlling stake in Tennessee Coal, Iron and Railroad Company, a steel producer that competed directly with Morgan's own U.S. Steel. Morgan could save the brokerage, but only if U.S. Steel acquired Tennessee Coal, which meant eliminating a competitor under the cover of a national emergency. There was just one problem: it might be illegal. U.S. Steel already controlled 60% of American steel production. Acquiring Tennessee Coal would push it past every antitrust threshold. So Morgan did something extraordinary. He sent 2 of his partners to Washington on an overnight train to meet with President Theodore Roosevelt, the most famous trust buster in American history. And he asked for permission. President Roosevelt faced an impossible choice. He had built his political career on breaking up monopolies. He had personally sued J.P. Morgan to dissolve the Northern Securities Railroad Trust just 4 years earlier. But now, in the middle of a national crisis, Morgan's men were telling him, "Approve this acquisition, or the economy collapses." Roosevelt had no way to verify their claims, no time to investigate, no independent advisors. He had to trust J.P. Morgan. So he gave his approval, verbally, with no written record, no formal agreement. Just a handshake delivered by proxy. U.S. Steel acquired Tennessee Coal for $45 million, a fraction of its actual value. Morgan eliminated his biggest competitor, and he did it with the blessing of the President of the United States. When the dust settled, the panic of 1907 was over. Banks stabilized, markets reopened, the economy recovered. J.P. Morgan was hailed as a national hero. Newspapers called him the savior of American finance. But beneath the praise, a darker question lingered. Should the fate of an entire nation rest in the hands of one private citizen? Congress certainly didn't think so. In 1912, they launched the Pujo Committee hearings to investigate the money trust, the concentration of financial power in the hands of a few New York bankers. Morgan was called to testify. He sat in the witness chair, cigar in hand, and defended himself with one of the most famous lines in banking history. "A man I do not trust could not get money from me on all the bonds in Christendom." He argued that the entire financial system was built on character, not collateral. That trust was more valuable than gold. But the committee saw something else. A system where a handful of men controlled the flow of capital to entire industries. Where corporate boards were interlocked like a spider's web. where competition was an illusion and power was hereditary. They saw an empire. And empires, by definition, are not democracies. J.P. Morgan died in 1913, just months before the Federal Reserve was created. The Fed was designed to prevent exactly what happened in 1907, a system so fragile that it required a private citizen to hold it together. But here's the irony. The architects of the Federal Reserve were the same bankers who had gathered in Morgan's library that night. Paul Warburg, Frank Vanderlip, Benjamin Strong. They didn't create the Fed to end the power of private banks. They created it to institutionalize it. The Federal Reserve System gave private banks permanent seats at the table. Regional Federal Reserve banks are technically private corporations owned by member banks. The New York Fed, the most powerful of them all, has always been dominated by Wall Street. Even today, the same patterns persist. During the 2008 financial crisis, Treasury Secretary Hank Paulson, a former CEO of Goldman Sachs, assembled the largest banks in a conference room and told them to accept government capital injections. It was Morgan's library all over again. In 2020, when COVID-19 threatened to collapse credit markets, the Federal Reserve intervened with unprecedented speed and scale, buying corporate bonds, municipal debt, even junk-rated securities. The system was saved. But who decided which companies lived and which died? Central bankers, Treasury officials, former Wall Street executives, not elected representatives, not democratic institutions. The same invisible hand that saved America in 1907 still operates today, just with a different name. And here's the question Morgan never answered, because no one dared to ask it. What happens when the people who control the money stop believing in the system they built? Because in 1907, Morgan saved America because he believed in America. He believed in industrial capitalism, in long-term growth, in the sanctity of contracts and the stability of institutions. But what happens when the next crisis comes, and the people in Morgan's chair don't believe in anything except the next quarter's profits? What happens when rescue becomes extraction? We may be about to find out. So what are the real lessons of 1907? First, power abhors a vacuum. When the government couldn't act, a private citizen did, and in doing so, he reshaped the balance of power for a generation. Today, when crises emerge, financial, technological, geopolitical, we see the same pattern. The institutions that step in during moments of chaos are the ones that define the rules afterward. Second, rescue and consolidation are often the same thing. Morgan didn't just save the banks, he absorbed them. He didn't just stabilize the market, he eliminated his competitors. In every crisis, someone gains, and it's rarely the people who needed saving. Third, trust is the most valuable and most dangerous currency in the world. Morgan's entire empire was built on the belief that his word was law. And for decades, it was. But when trust is concentrated in too few hands, it becomes indistinguishable from control. And control, unchecked, becomes tyranny. The panic of 1907 revealed something fundamental about how economies actually work. They are not machines. They are not governed by neutral laws. They are systems of trust, reputation, and power, and they are only as stable as the people who hold them together. J.P. Morgan held America together because no one else could. But the fact that no one else could, that was the real crisis. Because in the world of wealth and power, history never ends. It just changes hands. If this story made you see American finance in a new light, don't forget to like this video, subscribe to the Wealth Timeline, and turn on the bell icon, because the next chapter we're uncovering might just change how you see the world economy today.